Before you book that overbilling and move on, look over it to see if it makes sense. We're going to go over a specific example here, so stay tuned. According to our example here, we have estimated gross profit of 15%. This is all calculated based on the contract price and estimated total cost. Over to the right, we have the activity on the project, build to date, cost to date. Now, our actual gross profit on this project, considering build to date and cost to date, is 47%. That's a lot higher than our estimated gross profit of 15%. Well, that means we are overbilled. Let's take it a step further and calculate revenues earned. Revenues earned is the amount of revenue we can recognize based on the percentage of completion method. Simplified formula here. The amount of revenue we can recognize is $564,000. That is significantly less than our build-to-date amount of $900,000. The difference between these two amounts, the $900,000 and the $564,000, is our overbilling amount. If you've already looked at your total estimated cost and believe that the estimates are all up to date, consider looking at subsequent cost activity. Subsequent cost detail will help you assess whether or not you have improper cutoff of job costs. By that, I mean you incurred costs through December, year end, but you didn't record those costs until the following year end, which is really inflating this number here. So when you look at that subsequent detail, pull up big transactions and look at the invoices. See which period they relate to. If you incurred that cost through the year end, you need to move it back. You need to move it back from the subsequent period to the current year period. So if you recorded subcontractor costs of $150,000 in January for work done in December, you should technically record that cost as of December. So then by doing so, you decrease this actual gross profit amount. So let's go ahead and add that amount here. $150,000 invoice that we did not record by December, but we looked at the subsequent detail and ended up moving this cost back, decreases gross profit to 30%, increases the amount of revenue we earned, the amount of revenue we can recognize. In that process, we decrease the gap between build to date and revenues earned, which in turn decreased our overbilling.